most respected faculty of today's VCM, Rengarajan sir from Cochin, Secretary of Kannur branch, Shivaprasad sir, Vice Chairman PJ, Member and immediate past Chairman Saju Sridhar, Treasurer Dinesh sir, illustrious past Chairman, members of the profession, and my dear other participants. Today, again, we all are delighted with the presence of one of the leading chartered accountant who is going to handle the topic firm versus LLP versus companies. And this is the, this is the second time we are getting this great person in dual capacity. In the original session, he was a trainer, yoga trainer, as a part of the International Yoga Day, where the branches conducted in association with the ISA Foundation, where I am actually excited by seeing the trainer who is a chartered accountant. Now he is in another role as a professional trainer who is going to handle the topic again, firm versus LLP versus companies. So we are extremely happy, and I'm taking this opportunity to welcome you to this virtual CP seminar, 21st virtual CP seminar of Kannur branch of SIRC of ICAI. And at the same time, I'm taking this opportunity to thank for accepting our invitation to be a part of this session as a faculty of the Kannur branch. So welcome you, sir. Welcome. I'm taking this opportunity to welcome all the members and participants and their great, and thanking for the great support extended to Kannur branch of SIRC of ICAI. Now, I just informing you that on 8th August 2020, that is on Saturday, and again you note down the time is 3 p.m. to 5 p.m. afternoon, 3 p.m. to 5 p.m. We are going to have another CPA seminar by another vibrant personality who is a direct tax professional, as a person well known all over India, who is an ex-member of Income Tax Appellate Tribunal, who is none other than CA Dr. Rakesh Gupta from New Delhi. And I'm taking this opportunity to thank the Suresh sir who has given the identity of this great personality. And immediately after contacting this person, this great professional, he has agreed, and he is going to handle a topic, e-assessment, how to make effective representation. To see his YouTube presentation, his background and everything, you can see that vibrant personality. And you should have noted down the time, that is 3 p.m. to 5 p.m. on Saturday. I am requesting all the members to fill the Google form, which is a mandatory requirement for the CPA credit to the Kannur branch members. And I am also informing you that the Kannur branch has restarted after this corona issue. We have restarted the orientation and ITT program for the CA students. Today morning we have started at 10:30, and the first batch itself is full, above the entire 50 students are there. And the second means another batch of ITT that will commence tomorrow morning 10:30. So we are happily commenced both the orientation and ITT in the Zoom platform. So I'm just informing you, and encourage all the students to be a part of this orientation ITT only through Kannur branch of SIRC of ICAI. And now I request the Vice Chairman, CA PJ Reggie, to formally introduce the faculty, CA Rengarajan sir. Please, Reggie.
Respected Chairman, CA Jayaprakash, renowned speaker for today's webinar, CA G. Rengarajan sir, Secretary, CA Shivaprasad sir, illustrious past Chairman of Kannur branch, Managing Committee members, my fellow members in the profession, students, and dear friends. It's my great pleasure and honor to present before you an eminent speaker for today's virtual CPA seminar, CA G. Rengarajan. CA G. Rengarajan, a qualified accounting professional having 13 years of experience in finance, accounts, auditing, and taxation. He handles clients from diverse sectors, including banks, financial institutions, agriculture, software, logistics, textile, paper industry, defense, electronics, telecom, hospitals, hotels, plastics, paint industry, and so on. Presently, he is a partner of Mrs. Suri and Company Chartered Accountants, a reputed firm of chartered accountants with a proven track record of professional excellence established way back in the year 1939. He has been associated with this firm for 18 years since 2002, starting his career as an audit assistant, and on clearing the chartered accountancy course in 2007, he continued with the firm as an audit manager. He elevated as the partner of Mrs. Suri and Company Chartered Accountants, Cochin in July 2010. He is the partner authorizing the financial statements in Indian GAAP, Ind AS of corporate groups having a group turnover of 2,500 crores. He also handles direct domestic tax matters, indirect taxes, and related appeals before the authorities in India. He has extensive experience in undertaking audits, studying clients' business, planning internal financial controls, and risk-based internal audits. He has wide exposure in statutory audits, tax audits, internal audits, group reporting, public sector financial institution, and other special assignments. He has completed certification course on IFRS, international taxation, and indirect taxation from the Institute of Chartered Accountants of India. He was a faculty at the ICAI and ICAI in Cochin. He is a session speaker on topics of Companies Act 2013, international taxation, income tax, GST, and FEMA at various branches of ICAI. Presently, he is the co-opted member of Standards on Auditing Committee of SIRC of ICAI. Dear members, this is the brief introduction of the speaker, CA G. Rengarajan. Sir, we are extremely happy and delighted to have you here in this evening as a speaker for today's virtual seminar. Thank you, sir.
Thank you, Rajiv. Now over to Rengarajan, sir. Before that, I just pressing record of our sincere thanks to CA Dinesh, sir, for his extreme sincere and dedicated effort for the last 2 days or 3 days, we could say 3 or 4 days, to have this orientation and ITT program in virtual platform. He has done all the technical arrangement so that today, without any break, we could commence the program. So I'm thanking Dinesh sir for his great and sincere effort. So now over to Rengarajan, sir.
Good evening. Namaskaram to everyone. Respected Chairman, Secretary, Treasurer, Past Chairman, and other members of ICAI Kannur. It's a great pleasure to present a paper at ICAI Kannur. I've been, like Sir said, this is my second appearance before you all. But first thing was as in a different dimension, and the second thing is coming as a completely different dimension. And I would obviously prefer to be known more in this dimension than the other dimension as such. So yes, I've been associated with Isha for some time, and I've been doing some activity for them as a volunteer also. So thank you so much for having me here. Hope all of you are safe. We were just discussing with Chairman and Past Chairman, saying that how COVID has made all of us very punctual to come back home and look at stuff, work from home as in different auditing structures, and how Zoom or other VC methodologies have been taking over, and how technology is being driving us for the past few months. Considering all this, I think the way forward is also going to be on the similar lines. We don't think things will go back to any way called as normal in any part of 2020. Hope 2021 is a bit different than what we have in 2020. So let's go into the topic straight away for the day. Let me just share the screen. Are you all able to see the screen?
Yes.
Yes. Sir, I think our voice കുറച്ചുകൂടി ഒരു clarity ഒന്ന് അടുപ്പിക്കും.
Okay. Is it clear now?
Yeah. Okay.
Yeah. Thanks. So now let's go into the session. Today's topic is about partnership versus LLP versus Companies Act. This topic is quite a hot topic whenever we come across clients, and whenever they come to us, they come up with options. They ask us options as to which is the most ideal way to start their business. How do you take it forward? What is to be done? So we always look at the most comfortable option of all, which was the partnership. If it's more than one person involved, then the most easiest and the most comfortable option to start with the easier registration procedures and documentation procedures, is always a partnership. So we always start with partnership. We go ahead with that as a business entity. Going forward, see what is happening and other things. But of late, there are different forms of business organizations which are planned, which are structured based on the tax shields, tax benefits. There are a lot of structuring or tax planning which can happen. So looking at all this, there are certain benefits which can seep in. So it is not, it's no more, I would say last 10 years, there have been substantial change. Even if someone comes to me 10 years before, I was always prompting for a company than any other option. One good thing is it was always my strong zone, so I always preferred companies over partnership firms or LLPs. But all said and done, that was the way forward for me. And whenever people came to me as a tax planning structure or on a continuing basis of a business, perpetuity of a business, and things, company was the way forward for me. But I always gave them options of what are the do's and don'ts, how to address it, what could be done, what need not be done. Based on all this, the discussions, we used to let the client decide as to what could be done. So with those thought processes, I am presenting today's paper. So to brief up, I don't think anyone needs an introduction to a Partnership Act. Section 4 of Partnership Act is very, very clear. It brings out what is a partner, who is a partner, what are the relationships. Main thing in a partnership, obviously, is that there should be an agreement between two or more persons to share the profit or losses of a business. The business must be carried on by all or anyone acting for all. But the difficulty is it has an unlimited liability. The responsibility on the partners is unlimited. So to that extent, there is a burden that is to be carried. And there are restrictions in terms of transfer of interest. So once and partnership is to be revisited, if someone is coming new or someone is retiring, then we look at options of dissolution and reincorporation of the same name. All those kind of structurings are needed. So this is the basic that we all know. Then we have a bit of an elevated structure of a partnership, which is LLP, which came in 2008. For me, LLP was a strict no-no till around 4.5, 5 years before. Because people who came to me for looking for LLP were people who are in partnerships. The difficulty in addressing a partnership client is the way they handle their funds. Okay, the major difficulty is the way they have their drawings and the way they plan their cash flows, and the way they maintain their books of accounts. So these three were always a challenge for any auditor, according to me, when it is a partnership concern. So whenever someone comes to me with an idea of LLP and they want to move their partnership into LLP, I had a very bitter experience of converting one partnership into an LLP of somewhere around 2009, 2010, very early stages of LLP itself. And they still continue to do their business like a partnership. And because of the delays of non-filing of forms and other things, there was a substantial liability, and to that extent, we were forced to kind of charge that kind of a heavy penalty, pay the penalty for on behalf of the client and all. So that came as an heavy jolt on us. So from that time, I said no to LLPs. I said nothing doing LLPs unless and otherwise people are very clear on the do's and don'ts of LLP. We should not recommend LLP to others. But in the last couple of years, even though things have not changed drastically as per the Act, but a lot of people have come up with an open mind towards LLP. So they are a bit more streamlined in their businesses, streamlined in their activity. And hence LLP is a very, very vital option these days. LLP, as per Section 3(1) of the LLP Act 2008, it says it's a body corporate formed and incorporated under this Act and has a legal entity, legal separate entity from its members. So technically, this is the clear distinction which kind of gives the benefit to a person who wants to start a new LLP. Unlike partnership, the liability is limited. You have a separate legal entity by itself. So we have quite a few LLPs where all the trademarks, especially smaller LLPs, where they are trying to do some research activity, they're building up a base kind of a structure. For them, LLP is a much viable option because the trademarks and other things are getting registered under the LLP name. So we even had an opportunity to discuss on the transfer of an LLP as such, or conversion of an LLP to a company and then transfer it from there on. So the trademarks and other things was very easily transferred from the LLP to the company. So those kind of structuring, planning and identification of an opportunity is wide open under LLP. The main features is the limited liability to the partners. Obviously, ROC steps in because it gets the corporate shield, it gets the corporate protection. So ROC steps in and it starts monitoring out. So there are a lot of, there are a couple of forms predominantly which is mandatory as such. And once you are much more comfortable in maintaining a proper books of accounts, these are very easy to be managed. Then the activities, economic rights of the partners are freely transferable. So one person can transfer it to other without any disturbance. So bringing in a person, taking out a person in LLP is much easier than what it is under a partnership. We get a separate legal entity. So the LLP stands on its own like a company itself. So it gives us that shield also. Every partner is an agent of the LLP but not liable for a wrongful act of other partners. So this is the biggest shield that we get under an LLP right now. Unfortunately or fortunately, many times because of lack of information, the partners, amongst partners, there comes a dispute and it is forced for a dissolution and other things. So here, to that extent, it's easier to eliminate a partner and bring in a new partner. So that advantage is definitely there under LLP as such. So this is a small brief on LLP. And coming to my main attraction, Companies Act, Companies Act 2013. We had the 1956 Act earlier, and then now Companies Act 2013, which came in. A company under a Companies Act means it should be incorporated under the Act or under the previous laws. Very similar to LLP. Again, it says limited liability of partners. What they maintain with partners is the promoters actually. Then it requires registration with ROC. It gets a legal separate entity, and there's a transferability of shares. So again, planning for a partnership, planning for a private limited company is much more comfortable. I've always played around with Companies Act as a major tool. A lot of structuring, a lot of tax planning, a lot of indirect tax planning could be effectively done if it's a company. But the challenges are you have to be a bit more compliant when it comes to a company as against LLPs. So if you look at the structure between a firm versus LLP versus companies, firms are a bit more comfortable, relaxed to handle. LLP has its own difficulties, a smaller difficulty. Company is having a bit more, one step higher challenge in terms of documentation and registration and other procedures. Other than that, I would say the cash flow management is the only point which we may need to address. And if that is taken care, I would always prefer a company over any other entity for that matter. So that is the general brief about companies. So we'll quickly jump into the comparison between the three. Feel free to stop me anytime and ask your doubts or clarifications. I'll be happy to take any of the queries at any point of time. Need not be at the end of the session. You can talk to me anytime. I'll be able to answer it as and when we go ahead. The difference between the three, starting with the basic, obviously three are governed by three different laws. Partnership is governed by Partnership Act of 1932. LLP is covered by LLP Act of 2008, and the Companies Act is the latest baby. Companies is governed by the Companies Act of 2013. So out of the three acts, which is more in terms of reliable, which is more in terms of compliance, which is more in terms of safer route, obviously Companies Act 2013 takes that benefit. It gives you a lot of benefit to the shareholders, to the directors. If the person who is investing the money is not keen in running the business, he just wants return on investment, whereas a person who is willing to take the risk and do the business is unable to fund the business, then I would obviously go with company as the best tool on that. Partnership in those terms also becomes quite difficult. I would say it is not viable in terms of partnership, but obviously LLP gives us a comfort zone. Out of the three in that terms, LLP or the company would be the most vital in terms of law, because it gives you the protection, it gives you the comfort. Obviously, there is a bit of compliance procedures to be looked into, and bit of managing, a bit of more regularized management that needs to be done. Other than that, Companies Act 2013 is very, very strong. Unlike Companies Act 2013, which was in the first year, the present Companies Act, after so many amendments in the last 7 years, present Companies Act has evolved. It is giving us a lot of comforts, a lot of benefits, different types of companies, different formations, different level responsibilities, lot of benefits for smaller organizations. So looking at all this, companies is not running behind or it's not losing the race when it comes to partnership versus LLP. So the next thing is registration procedures. Under Partnership Act does not mandate a registration, but you can register a partnership. You can go to the register of firms and then get yourself registered. Obviously, registering a firm has its own advantage, but not many of them take that advantage. They still feel it to be an unregistered firm is good enough. So partnerships does not require a specific registration, whereas in LLP or a Companies Act requires a mandatory registration. Both these laws make it compulsory that you have to get yourself registered. Once you register alone, you get the separate legal entity requirements. So that makes these two laws unique. Both of them go to ROC predominantly, Register of Companies. Obviously, under Register of Companies, there is a Register of LLP also. So to that extent, these two acts make it mandatory for a registration. So, when you are looking at registration as a mandatory compliance, so the formation of an entity also becomes through the law for LLP and company, whereas it becomes through contract for partnerships. So that what do we mean by that is, in a partnership, it is only the Partnership Act, the contract between the partners, which is binding, which drives the whole business activity. Whereas when it comes to LLPs and companies, obviously you have a memorandum which drives through, a trust deed which drives through. So all these are the primary requirements which will be looking into the activity. So going forward, so minimum number of members in a partnership, we all know that minimum 2 people are needed to start a partnership. You cannot start partnership without that. And maximum we can go up to 10 to 20 is the most ideal numbers for a partnership. LLP, technically speaking, again you have a restriction. The minimum obviously has to be 2. But maximum there is, as per the statute as such, there is no restriction. So you can go to any number under an LLP, but I have not seen an LLP bigger than 40, 50. Or in my personal experience, I have not seen anything bigger than 40, 50. I think the biggest I have seen is around 50 members. So again, it becomes a bit more clumsier when you have more members because each one is handled in a different way. But other than that, because the regulation steps in, the law steps in, the way they handle themselves becomes regularized through the act. LLPs with that number, kind of a number, is becoming a viable option, becoming an easier option. Whereas in a company, I have put across for private limited companies and public companies in my presentation. In a public limited company, you need minimum of 7 people, minimum of 7. For a private limited company, you can start with 2. But now you have also an option called as 1-person company, which is you can still start with 1 single person. So it's something like a sole proprietorship under a corporate shield. So if that is also possible. Whereas the maximum number, obviously a 1-person company is just 1. Whereas in a private limited company, you can go up to 200. And for a public limited company, there's no actually restriction there. So you can still go to any number. But when do you look at an LLP or a company is when the investors versus your the person who is actually doing the business. If that distinction can be established, then I think LLP or a company is more ideal combination. Obviously, LLP takes a better shield when it has multiple people from multidisciplinary coming together. I've seen a lot of firms these days where CA, CS, and CWA are together, and the opportunities are thrown open because of such kind of an arrangement. So like that, I have quite a few LLPs where doctors are involved. We have a few when an idea comes up of putting up an hospital kind of a structure, then each doctor will have to have a significant role. So a gynecologist or a different person from a different field comes in, a pediatrician wants to come in, a dentist wants to come in, a dietitian wants to come in. So when these kind of structuring are there and they are trying to play within their strengths, the only option, if for example, if it's a dietitian, the person of a dietitian may have to be forced to work somewhere than start their own business, start their own practice. So they are always in a fix, or they always feel they have to go with someone or work under someone in many structures. So LLP came as a great boon to them, and it is becoming a viable option that many of these facilitated different types of facility doctors come in, specialty doctors come in, and they take their own share. They know the time spent. They're very clean. They have a complex, and they just have to ensure that the time spent is appropriate. Take the share of their revenue based on the time spent and other things. So it's becoming very viable option. In fact, one of my friends from Chennai told me there is an LLP where they have an veterinarian also as a part of the doctorate. There are 5-6 veterinarians who are coming together. So the hospital is actually a pediatrician hospital plus a veterinary hospital. So it is divided into 2 parts. Obviously not together in one building, obviously 2 different buildings, but the same locality. So and they have a kind of an option where the children can go and then spend time with the pets and all those things and come back. So it gives them that kind of freedom. So so people are thinking just out of the box from anywhere to ensure that they as a professional or as an entrepreneur or as an business procedure, how to take it forward is just an n number of business opportunities. So that is obviously available under LLP. So that kind of a liberty is not there under partnerships. So that's where the why partnerships are not no more the hot favorites these days, is because of these kind of benefits that LLP throws open. So with that, the maximum and the minimum numbers, these are all the requirements. Once it comes to legal proceedings, only the registered partnership can sue a third party. So that is the biggest advantage of going for a registration of a partnership. When you go for a registration of firms and register your partnership, the partnership as such can start suing third party for any lack of activity. Whereas in an LLP and a company, since they are legal entities by themselves, they can go ahead and start filing suits. They can start representing on behalf of the LLP itself or the members of the partners of the LLP. And the company, obviously, through its directors, can take it forward. So these are all some of the advantages which LLP has over the partnerships, and obviously a registered partnership also has a similar advantage. The biggest challenge when we always start discussing with clients with regards to a partnership or an LLP is the cost. Is the cost involvement. How do you, when you start forming itself, the cost of formation for a partnership is literally negligible. It's only the stamp paper that is valuable right now, and you just buy the stamp paper, and from there on, everything is much more easier. And my senior says, if it's a partnership, always ask the partners to buy one stamp paper on the 1st of April. We don't know what changes they're going to bring it up after the time of audit. So always advise them to get a 500 rupee or 1000 rupee stamp paper and keep it. Stamp paper is always equal to money, he says. So that is the way we always handle a partnership. But an LLP and a company is a bit costlier compared to partnerships. Obviously, because of the ROC stepping in and the fees involved in terms of registering the entity. For an LLP, the cost of formation is the statutory filing fees, which is comparatively lesser than the companies. Here we look at only the turnover or what is the prospects and other things, and then take it as an initial fee. Whereas for a company, it is always linked to the authorized capital. We all know about the authorized, the paid up capital, the issued capital, the paid up capital, the subscribed capital, and all. So it's obviously based on the authorized capital. So fixing the authorized capital is always the challenge that you have to face when you are always forming a company. Because when you tell them that higher the authorized capital, higher the fees, the first reaction of the client is, we'll just start the company with the minimum capital, sir. What do you think is the minimum capital? So we say, you can even start with 50,000 or 1 lakh. You say, that should do, sir. We'll just start with 50,000. Anything else we will pump in a different mode and all those things. So, but that's not the ideal way to look at it. If a person is able to cleanly look at him or look at his business and plan a 5-year structuring and all those stuff, I think taking an higher authorized capital upfront has his huge benefit. Why is because through some small experiences that I had through my firm, we could plan a structuring for a private limited company, and the only thing I told the promoter at that time was, sir, why do you see yourself 5 years down the line? And he was very, very clear at the time. He said, Ranga, I'm planning for this. I'm sure by 2 years, 3 years down the line, this as a product will come out. And once the product comes in, 1 year maximum, I'll try to sell the products, make some revenue out of the products. And definitely once the market is arrived for this product, I will definitely start looking for a buyer for the company as such. and I start going into my next this thing. I cannot sit and make one kind of a product all the time. And when he told me this kind of a plan, and he was clear in his mind, so we knew what were the requirements in terms of plant and machinery, what are the requirements in terms of raw materials, bag, how much is his cost which he projects for 2 to 3 years, the escalations that he planned, which was not needed as such, and those kind of structures. When it came, then we very comfortably arrived saying that okay, don't worry, we can go up with say 60 lakhs as your capital upfront. I think 60 to 70 lakhs would be the ideal structure for you. We started with 60 lakhs there. Sorry, we started with 60 lakhs there, and 4 years down the line, he hit the nail on the right spot, and 7th year he sold the company. So that way, it became very easy for us to handle, and it didn't breach. We were still within that 60 lakhs as a limit. We could still plan everything within that 60 lakhs. He always took our advice and then planned accordingly. He ensured that his documentations were always within the limits. So when that came in, it actually we found out that compared to another entity, kept changing or kept increasing the authorized capital. It actually became much more cheaper option. Okay, in between there's one question which has come up, whether the number of partner permitted has been enhanced to 100. Technically, sir, I am not able to answer that question because according to me, no. But I have been reading articles on it, but I'm not able to pinpoint the provision wherein it says you can go beyond the number of 20. When it comes to obviously banking sector and other things, I think it has been enhanced to 50 if you are looking at a banking activity and other things, or an NBFC can have an activity. But to 100, I've only read articles. I'm not able to pinpoint in the law wherein it is permitting. Whereas in the Partnership Act, technically does not have any numbers to restrict it, but through the ways or through the modules or through the businesses where they are involved, the restriction comes from 10, 20, 50 and on through the business activities that are involved in a partnership, and it's not as such through the Partnership Act. But I have also definitely read articles saying that you can go up to 100, but I have not seen that kind of structures. Anything beyond 30, 40, I've always seen it's only an association of persons. I've never seen an option of more than 25, 20 people as in a partnership as such. So this is my my view on that kind of question. So coming back here to planning of companies things. So in that structure, so if you find a plan, a person with a concrete plan, then authorized capital fixing and the documentation upfront will be much easier. But that doesn't have any restriction as such. As and when you need, as and when the requirement comes in, you can obviously increase. We have even big listed entities who come up and then say, we want to issue bonus to the shareholders, so the present limits are no more, not possible, so we have to increase the authorized capital. So increase the authorized capital to the next year. So yes, we can still go ahead with it. So that is the only hitch in terms of a company. Without increasing an authorized capital, you will not be able to go forward. Which is not there under partnership, obviously. So that's the difficulty there. So then coming to the documents which are of primary importance, partnership deed obviously is the primary document for a partnership. It records the character of the firm, it denotes the scope, the rights, the obligations of the partners, the duties of the partners, it tells what is the share of profits, who is the working partner. All these are documented in a partnership deed, which is signed by all the partners. So that is a key core of a partnership act. Whereas in an LLP, an LLP agreement is the driving force. It's like a trust deed. That's the primary documentation. It's more like a partnership deed. But it also has its characters, it knows its scope and other things and all. It is also a bit more detailed than what we draft for a partnership deed. Okay, especially because the LLP Act steps in. we look at that, and based on that requirements, the LLP deed is a bit more detailed than what is there under a partnership deed. And obviously under a company, we all know that memorandum and articles are the binding force. The only challenge that we find under Companies Act is that anything beyond the activities mentioned under the memorandum and articles of association cannot be done. So that's the only challenge. Whereas in a partnership deed also we have the similar kind of restriction, but we leave it open. We at least add one line in the deed saying that whichever, if in future, if the partners feel a viable business is coming through, and through all of them accepting to that business, any business can be taken. Even though the specific business is mentioned in the partnership deed, we leave the option open for taking up any opportunity, so that we don't come back and revise the deed. Such kind of benefit is not there under Companies Act. So that's the only challenge that we do. But to that extent, again, we try to get over it. We try to put all possible businesses. Earlier and all, if you see the memorandum and articles of association had some main objects, then the auxiliary objects, and we could put anything and everything in auxiliary objects. But once the documentation became e-mode, electronic mode, the restrictions also started coming in. So to that extent, now it's restricted to a fewer line items. So, but still, it is not a challenge to incorporate more data into it. So it's still possible to do it. Then formalities of incorporation for a partnership, very simple process. Get the deed done. Get it registered. If you want to go in for registration, go to the register of firms, get it registered after getting signed from all the partners. Obviously, if you are registering the firm, there is a small registration fee which is attached to it. Whereas for an LLP, there are various e-forms which you have to do it. We'll look at it in the next few slides. Obviously, when it comes to Companies Act also, we have been talking about the Memorandum and Articles of Association. There are also slides I put on what is the need. So again, you have to start with the DSC, the Director Identification Number, and other things, and then you can start it off. So how quickly can you start? Partnership is immediate. LLP will take a bit of a time. Companies Act will take a bit more time. That's the only difference. But again, it's all easy. Why I'm saying this is because earlier, even now, if you are registering a partnership, registering the partnership, then going and taking a PAN for the partnership, then taking the GSTN for the partnership, all this has its time frame. So you can go up to a maximum of saying if the PAN comes by 15-20 days, the GSTN registration comes in another 5 to 10 days, maximum of a month you can get the business going in a partnership. Company is no different. Nowadays the forms are so easy that on application of the company name and the memorandum and articles is getting registered itself, they give you an option to register for the PAN, TAN, GSTN, everything comes in one single shot. So it is equally same time consuming. Within 15 to 25 days maximum, you can get yourself a fully formed company with all the registration numbers in it. So it becomes, I don't find time frame as a different structuring unless you are a very small partnership firm. You just want to start it with a timid number with just a PAN and other things. Other than that, time consumption for formation is almost the same. Yeah. Then the thing is about the principal-agent relationship. According to Partnership Act, Section 18 of the Act says the partners are agents of the firms and other partners. So what does it mean is, I represent my firm, I represent all my other partners to you. So if anything I am doing, it means that I am doing on behalf of the firm, I am doing on behalf of the partnership. So that is the challenge. So but when I am doing something as a partner of the firm, then all this gets tagged in. Okay, obviously when I do something as a personal activity, that will not get tagged in, but anything I'm doing as a business activity or as a part of the firm, then I am the firm for you, and I am the person on behalf, I'm the face of the remaining partners to you. So that's what is about the partnership. Whereas when it comes to LLP, obviously the shield is there. Okay, according to Section 26 of the Act, partners act as agents of the LLP and not of other partners. So that is the first shield which comes in. So what they're trying to say is, yes, if I'm representing the firm, I'm representing only the firm. I am not representing the other partners. So to that extent, any wrongdoing of one of the partners need not be casted onto the other partners. So that is the one of the primary attractions where I would say people who are stepping in, the younger generation of people who are stepping into business are looking at it. Okay, they are definitely confident on their friends and other people or the business partners who are coming in, but they also want to shield themselves. They say, I know that that fellow is good enough, and it is an open forum that discuss. They discuss. They say, yes, I know B is very very capable and handling stuff, but something he does, I should not get caught. So give me my shield, give me my protection, and that's where LLP comes in very very clearly. So that advantage LLP has thrown open. Then company as a in company, the directors act as agents of the company and not of the members. Obviously, we know there are two groups of people who are involved in the company. One is the investor group, who are called as the members or the shareholders, and the other set of people who are the people who are running the business or the directors. In most of the private limited companies, shareholders and directors are one and the same. But in a bigger organizations, you find the shareholders to be different than the directors. Okay, and there are smaller private limited companies also where the directors and shareholders are different. I have again given an opportunity, I could talk to one set of people where the father, uncles are all the shareholders, whereas the younger generation, the cousins came up together and they were the directors. So again, that was also a viable option. The fathers were only interested in investing the money and getting the money out of the company, whereas the younger generation was interested in doing the activity as such. So that way, it was always an option. Again, another doubt. Shekhar sir has said the Companies Act 2013 is allowed 100 members to form partnership. Previously, 20 firms is an illegal association. Whether 100 people are allowed to form a partnership. Again, yes, sir. Yes, this is where I'm seeing. This is also is what is the articles and other things which I've read as linking up to. But how far is an 100 people coming together as a partnership activity as such? I have not seen. In my personal experience, I have not seen such kind of an activity. It's theoretical, yes. Possible to do it? I don't think so. I don't think that kind of a structure, that kind of a number will work in a partnership. Theoretically, yes, that's what the act says. That's how the provisions say. So that is how we are getting at the numbers called as 100 as a maximum number for a private limited, for a partnership and all. But Act as such does not say. The Partnership Act as such does not say, and there is no other restriction anywhere other than that. So yes, you can have 100, but technically that's not a viable route for a partnership. Partnership ideally 20, not beyond that. 20 handling 20 partners itself is a challenge. Anything beyond 20, it should be only LLP. According to me, it is, if you're touching any numbers around 18, 19, then the viable route is to go into LLP only. Yeah, so this is about company. So the director as such acts on behalf of the company. He is the one who is the face of the company and not the members, and he does not represent as such the members as such. Obviously, he reports to them for their requirements. Then transferability of interest in a partnership. A partner can transfer his interest subject to the partnership agreement. Generally, we put a restriction clause in a partnership agreement saying that it has to be only with the consent of the remaining partners, either to the existing partners first, and then if not to the existing partners, to outside people based on the consent of all the partners. That's how we put it out, or we are generally say dissolve the partnership and take another registration or another partnership is what it is. Okay, thank you, sir. I think Mr. Shekhar sir is from Salem. He's joined us from Salem. Thank you so much, sir. Thank you for joining from Salem. It's a pleasure for us. Welcome to Kerala as such. me being a part of Tamil Nadu, it's glad to see people coming from Tamil Nadu here. So very, very good, sir. Thank you so much. The next thing is about the transferability. We are talking about transferability issues here. In LLP as such, the partner can transfer his interest subject to the LLP agreement again. But in an LLP agreement, we make it as a viable option. We always say the partners of an LLP have their liberty to transfer it out. Obviously, we have to go to the existing partners first and then to outsiders as a safer route. That's always the ideal or the best practices. But is there restriction in the LLP Act? Yes, LLP Act also suggests that, rules suggest that it has to be going in that way. Whereas in a Companies Act, the members are free, especially if it's a public limited company or not. The members are totally free. They can go transfer their shares to anyone and go out. In a private limited company, again, we put this restriction. We say to the existing shareholders first, then to outsiders. But existing shareholders are not interested in taking it. Obviously, the outsider is the only route out. But a lot of structuring, planning, and other things can be done by which we can sell the whole company as such. In fact, when we actually planned for a partnership firm, they were keen on buying a property. Okay? And the intention was not to do, they were very clear on the mind saying that this property, as of now, is coming at a reasonable rate. We are buying it out. So definitely 2 years, 3 years down the line, it is very close to the highway. So it is going to go up. Once 3 years down the line it comes, I'm just going to sell that property and go out. I'm not planning to do anything beyond that. So we registered a company as a real estate company with the intention of developing that land and building with a joint venture or any other company coming in to build a option. They also had that as a plan. But 1.5 years, 2 years down the line, they found a builder, proper builder who wants to construct a mall in that locality, that place. So he came up and he said, what is the structure and other things? He said it's a company holding the land. Then he said, I'll buy the company. So it was a very easier option. So the stamp duty that we paid once was the only stamp duty that had to be paid. If not, what would have happened is every time the valuation goes up, you have to pay a stamp duty on that value. So it became an easier option to sell out. Obviously, the valuation of the company will be involved, and the stamp duty for the shares are obviously involved. But that is reasonable and that is definitely manageable. And registry and transferring the shares of the company is much more easier than going to the registrar or changing the name of the particular land and building and other things to another person. So much more easier to handle. So these kind of benefits obviously they are under partnership under Companies Act. Then going into the other statutory requirements in various laws, whether meeting is mandatory in a partnership act, there is no provision which says there's a meeting which is mandatory. So that means to say you need not have a meeting at all. But how many businesses run without a meeting is a challenge. But yes, there is no requirement to legally have a meeting. In an LLP also it holds good. There is no statutory provision which says you have to have a meeting of all the partners. Whereas this is the difference where Companies Act streamlines the business line. Okay, so what happens is it makes it mandatory. Companies Act makes it mandatory that we should have at least 4 board meetings. The board of directors should have met at least 4 times in a year. They should have discussed something. There should be something called as a minutes that has to be recorded, and it has to be signed and circulated to all of them. Definitely once in a year, the shareholders have to meet. That is called as an annual general meeting. So we all know about the AGMs. So definitely once a year, the AGM has to be conducted and the shareholders have to meet. Any number of times the shareholders can meet in a year, but that will be called as an extraordinary general meeting, EGMs. But mandatorily only one AGM will be there in a company. So these 2 meetings are mandatory, and there are rules formed as to how to go ahead. This year is going to be a more challenging year. Why? Because many partner private limited companies with having directors at different locations. Okay, generally what happens is if the directors are not able to travel, uh, they are very comfortable over phone, so they discuss over phone, but there's only a quorum needed in the physical meeting. We have the physical meeting with the minimum number of people for the quorum, and the other people join. They are participating, but they don't sign the minutes. So it becomes much more easier. But other directors, on receipt of the minutes, acknowledge that particular minutes. But now, because of COVID, getting a quorum is being the challenge. So far, my office we have been doing only Zoom coordinator. Like the chairman was just appreciating Dinesh sir for organizing the Zoom meet for the students for the ITT and other training. We have been that kind of a service provider for our clients because most of them are new to this kind of a technology. So even though they are very very well versed in terms of technology, we have to go record and ensure that what is to be said, how it is to be said. These kind of difficulties are there if you read the rules under Companies Act. There's I call it a script. Whenever I discuss with my clients, I will say, I'm sending the script, sir. Please read the script. Please go through the script. You should read the script in the meeting, is what I always tell them. So there's a procedure to be, or a protocol to be followed. So those protocol following up is a challenge in the present scenario. Otherwise, again, under the old regimes, private limited companies never had a difficulty as long as there's a forum. Just ensure that the meeting is done. Okay. Next is on audits, which is our key area. Partnership Act as such does not mandate an audit. So only their tax audit requirements and GST audit requirements that they come to us. Other than that, there is no other requirement. Obviously, banks insist on audited accounts or audited numbers, then they come to us. Other than that, there is no other requirement for a partnership under the Partnership Act to get it specifically audited. For an LLP, it's capped to the turnovers and the capital. If you are below the limits, then there is no requirement for us to do an audit. But most of the times, LLPs feel more comfortable to get their books audited because the forms which are filed is again filed by the chartered accountants for the LLPs. So for that, again, the books of accounts maintained is regularized or is reviewed by the chartered accountant before the forms are filed. So that becomes a mandatory, or it becomes an indirect way of auditing, and so audit becomes a way out for them. So they are also very comfortable with an audit procedure. Whereas companies has made it mandatory for an audit. So one more very important factor for me to propose companies to all my clients has been this, because I will definitely be their auditor. So formation also is with us. So we form the company, we become their first auditors. From there on, we start becoming their auditors and take it forward. So audit is mandatory in the Companies Act. Your appointment is fixed for a period, for a term of 5 years. If your rotation is not mandatory for the company, then you can continue your tenure for another 5 years and keep going on like that. If rotation is there, then you take a break of 5 years and you can come back. So that's how it is being structured right now. I think Indian Companies Act is the only act which has that kind of regulation. But still, it's good if you get to see a lot of audits because of such opportunities. Then coming to the other primary differences, voting rights. Predominantly, yes, in a partnership, it depends on the partnership agreement. Predominantly, voting right in a partnership act is one partner, one vote, and all. I have not generally seen. It's justly based on the share of profits. So, if a person is having a higher share of profit, he gets to say. That's how it's there under a partnership act. LLP Act also, voting rights shall be described as per the terms of the LLP agreement. There also we predominantly link it to their contribution to the LLP. Contribution to the LLP meaning to say capital contribution or share of profit contribution or the contribution in terms of activity. These kind of structures, we have different structuring is done based on the need of the LLP agreements. We structure it that. Whereas under a companies, it is prescribed under the Act and the rules. It says one share, one vote predominantly. One right is one share, one vote predominantly, unless and otherwise you change the procedure. Unless you change the procedure or change the memorandum and articles to that extent. Generally, it's one share, one right. So that's how it is. Then remuneration for the managerial personnel. So this is the difference between the three. Okay, under Partnership Act, there is no restriction. So most of the times, the partners take drawings. Every month they are used to taking the money out as and when the money is there, pumping back the money as and when their business needs. So these kind of structures is very, very common. And then at the end of the year, they come to us and we do our computation as per Section 40B of the Income Tax Act and say, okay, sir, you are eligible for so much only. If you take out so much money, then to that extent you get you get a deduction in terms of the Partnership Act. You save so much of tax, but in your personal hands you have the slab rate differential. So to that extent, we can plan your taxation or the overall structure of taxation. These kind of structures we do. Unfortunately, that is not a viable solution for companies. Even under remuneration under LLP depends on the LLP agreement as such. Here, in most of the LLPs, it's fixed. Okay, we go with the fixed plan, say that per month so much, or per month or per year, the maximum cap can be so much, like that. We fix and go. For LLP. Under Companies Act, obviously, there's a section called Section 197, 198 of the Act, which gives you the maximum amount you can draw. Obviously, for a private company, that is not applicable, so we still have the liberty of drawing whatever we want. But again, it depends on the cash flow of the business. And why I find it different, what is the challenge I always face when I'm handling clients is that in a partnership, if the partner is having funds in the bank account and he has some expenditure, he just pull it out. Tomorrow the business needs, he can borrow, do whatever it is, bring back that money and then put into the business and do it. Whereas in a company, you cannot pull out your share capital and put back your share capital. It's not going to work. Okay, and you cannot have a current account kind of a structure under a company. Even though many of the partnerships converted companies still feel current account of the partner or the directors is a mandatory requirement. We always say no, that's not viable. Because of the restrictions of Section 185, 186 and all this stuff. So we say no, that's not possible at all. So that being the case, yes. So that is the key difference between the three. Then coming up as an additional requirements because of the statute, we find that there is no annual return requirement for partnerships. There is no return that we need to file unless and otherwise it is required under the Income Tax Act or the GST Act. Until and otherwise these entities come up, there is no requirement for you to file any return. LLP, as I told you, two mandatory returns are there. Annual statement of solvency, accounts and solvency, and annual return has to be filed. The annual solvency statement goes first and the annual return goes. Annual solvency statement happens by June and return goes by September. So that's how we frame. Under Companies Act, obviously, now there is a single return called AOC4, which is an annual return. But if you are passing some resolutions and it needs a registration under Section 117 of the Companies Act, then you have to file separate forms for that. And obviously, there are various forms required for various requirements. So that being the structure, there are a bit more compliance requirements in terms of filing of forms. Like if I will talk about few of the forms in later part of the slide, like DAR3 and all those stuff, or DPT3, MSME. These forms are all additional burdens. If it all is there, it becomes an additional burden. MSM sir, I don't know his full form, sorry. He says, can you explain the variations of shareholders' rights? Okay, sir. We can formulate a company with different shareholders with different variations. Say, for example, in my experience, I have seen one entity. The group as such always operates that way. What happens is they have a primary contributor, okay, and they have the beneficiary and the sub contributors. The primary contributor wants the money from these people, but he cannot take it as a loan or anything else. So he has to make them the owner. Okay, so what we structure it out is we have three classes of share capital. Okay, equity share capital of 100 rupees fully paid up, equity share capital of 50 fully paid up, equity share capital of 10 fully paid up. Okay, and the 100 fully paid up is always the primary shareholder. Okay, and the rights are always with that of the primary shareholder. Okay, so for example, if a resolution is to be passed, okay, 10 people of 10 rupee shareholder have to come together to equate to one right of the primary shareholder. Okay, so that is how we formulate it. And anything and everything the lower shareholder people want, they always have to take the cognizance of the higher power shareholder for the activity. So that is how we have structured. So why we have structured in this format is because that there is a restriction under the Companies Act to borrow money. Okay, if it is a partnership, you can say it's a friend, he wants to lend money to me, he's lent money to me, I'm paying it back to him. All that as long as it's through the banking channels, it's perfectly allowed. But under Companies Act, that is not possible. And under Companies Act, there's one more restriction saying that as a person, as a shareholder, I cannot borrow money and invest the money in the company. That is also not possible. I cannot lend money. Shareholder cannot lend money from a borrowed funds. It has to be out of his own funds. There's a declaration, mandated declaration, which has to be given. So since these kind of challenges are there, we formulate these kind of structures. Why? And this ideal structures, what happens is it gives the primary shareholder, the promoter, the strength or the power. Any resolution without his vote, it will not go through. Okay, so what we have structured is he and his family will always have that numbers. Below him will be his close relatives who have invested. So they will have 50 rupees paid up share capital. So at least two of them together should come together to have one right, which is equal to one right of the primary promoter. Lower, then he has a lot of smaller friends and other things who will invest. All those people will be 10 rupee shareholders. So 10 of them have to come together to equate to his one right. So that is how we formulate. So it is legally valid, it is permissible as per the Companies Act, and it's still viable option. So that's how we structure it. Yeah, so going forward, the annual return, yes, there is a bit more forms which have to be filed under Companies Act. We'll look at that also. Then, if you're looking at foreign direct investments, FDI, partnership does not allow an FDI. That is not permitted. LLP, based on the sectorial cap, FEMA allows you to do it. Again, for Companies Act, based on the sectorial caps, predominantly most of the sectors these days are 100%. So under automatic routes, so it becomes much more viable to bring in a foreign investor, and a foreign investor always prefers a company over LLP for the activity. So that's how it is structured. So these are some of the differences. Then compromise arrangements in terms of mergers, amalgamations, and all. LLP, I don't think there's an option. I mean, partnership, I don't think there's an option called as mergers and demergers. Either dissolution, start, the new partnership continues with the same name or different names and all those kind of structures only. There is no other option. Whereas in LLP, you can get into a merger acquisition kind of structure, provided the provisions are within the four walls of LLP Act. That is still a permissible action. In Companies Act, yes, it is always permitted and you can always do it. The difference between an LLP and a company is that the LLP Act will restrict you to in terms of the merger structures. Demerger is not an issue. Whereas in a company, it's a bit more wide open. Two different entities, completely different businesses also can come and merge. Whereas in an LLP, that is a bit of a different. They should formulate in such a way that it comes into the requirement. Then the credit worthiness, obviously, out of the three, the most credit worthy entity is the company. Next to them is the LLP, and the least is that of the firm. But if the firm is there for quite a number of years and it has built goodwill over the number of years, then obviously they still have the challenge. They still have the credit worthiness. There's no difficulty in that. Then we look at the whistleblower options. Whistleblower options is not there under private in a partnership entity. That means a third person, an employee cannot go blow the whistle against the partner. That is not possible. The only thing he has to do is listen and go. Whereas in an LLP and the company, there are whistleblower options. So if a person is finding that the entity is not operating with the good intention, or anyone working below is feeling that they have to trigger the bell somewhere, that is still possible to do it. Okay, that is still possible for them to do such kind of an activity. So that is the primary difference. So these are all the differences that we need to look into for each of these each of these entities. So now quickly going into the starting up of the activity in LLP versus your company. How do you start? What is the requirements? When it comes to an LLP, we need a DPIN, okay? A direct designated partner identification number. A DPIN is a mandatory requirement. A person who's already having a DPIN, then it is not a challenge. So with that DPIN itself, we can go in. But if that entity or an individual is not having a DPIN, then the first step to be taken is to obtain a DPIN. Okay, and it's like through the Aadhaar and other registration details, we can get a DPIN, getting registered under the Companies Act or the LLP Act. Okay, based on this, we obtain the digital signatures. DPIN and the DSC go hand in hand. Okay, both go hand in hand, and we actually take the digital signature, and through that digital signature, e-forms are filed, so DPIN gets recognized to that extent. Then we obtain the name approval for the Indian, I put it as Indian company. It's Indian company means Indian LLP predominantly, for the purpose of ROC. We get the registration done. We ask for the name. Unlike in a partnership, we have to first apply for the name requirement for an LLP or a company. That's a mandatory requirement. You have to get yourself, your name has to be approved. Based on that only we can go. So every time we go to an LLP, they give us 4 to 5 options. We have to say first preference, second preference, third preference, fourth preference. Based on the preferential, if the names are available, and if there is tagged, if it is specifically tagged with a register with an trademark and other things, then it's much more easier to get. Otherwise, you have to ensure that no other entity is having on the similar name. That challenge is definitely not there for a partnership, as long as it is not a name like Reliance or the Tata, something like that. It's easier. It's even for a Reliance or Tata to get a partnership is as a name in their name somewhere. Is still possible, but technically speaking, people don't do that. But here it is difficult. In LLP, that is difficult. You have to get the ROC's permission. Once ROC clears the name, then we go with the prerequisite forms. As I told you, the LLP agreement. That's a prerequisite form. We take that form, ensure that all the important clauses in that form is completed, is filled. Based on that, we need to ensure that we document it and then file it accordingly. For the filing, there is a stamp duty payment which is needed. So that once that is also done, based on the ROC filing fees and other things, it can be taken through. The execution of the activity happens. Once the incorporation documents are filed with the requisite fee to ROC, the ROC will clear it. Generally does not take time these days, within a maximum of 5 to 10 days maximum. Once the name has been approved, we get the registration processes done. It's much more easier these days. Then once this registration activity happens, there's commencement of business certificate issued by the registrar of LLP. Once that is there, then you start the business. So till this time your registration process is complete, you cannot start the business. In a partnership, that's the difference. You just need to get your deed. If you are really lucky enough, you can get the PAN within a span of 1 week maximum. Once that happens, once you get the PAN, the number itself is allotted. With that copy, you can open a bank account and start a business. Here, it takes a bit more than that. It takes 15 days minimum to start an organization, but it's worth it. Once you get it, all details come in one shot, and so it is easier to start an activity under LLP. In terms of a company versus LLP, not significant differences are there. The difference is here we call it as a DIN instead of a DPIN. Here we go with the director, not the partner. Okay, there the partner, the person who's investing the money and the time, is the one who is taking the registration. Here, the person who's going to invest the time is the person who's going to take the registration. The director, DIN, director identification number, is the code. Based on, again, DIN and DSC go hand in hand. We take both the registrations. If DIN is already there, the DSC is already there, then it becomes easier to go ahead. If that is not there, then we apply for the DIN with the DSC. Ensure that the DSC ensure that DIN formality is completed. Once DIN formality is completed, then we go with the ROC, approval for the name. Once the name is approved, we file the memorandum and articles of association, which is the incorporation documents. Based on the memorandum, based on the capital clause, the authorized capital clause, the fees are fixed. On payment of the fees and filing these memorandum and articles of association with the ROC, they approve, and once the approval comes, we start the business based on the commencement certificate. Procedure wise, LLP and company formation is almost the same. Just that we call it DPIN there versus the DIN here. Other than that, it is the same, but the difference, key difference is here a director initiates the activity, there the partners initiate the activity. So here, once the director registers the company, he can invite shareholders to come. Okay, that comes only when the registration process, only when the memorandum and articles of association are coming in. That's when the first shareholders come in. Till that time, the shareholders need not be even looked into the picture. But most of the cases, the promoters, the directors are also the promoters, so they go hand in hand. So they start the entity, then they slowly build up the organization. That's the requirement here. Okay, now from now on, I'm trying to distinguish how LLPs or firms or versus a company, which is more appropriate, which is more ideal, how it goes forward. Let's take Income Tax Act right now. Okay. As of now, the firms and LLPs, as a rate of tax, they fall under the 30% slab. Okay. They are the highest under domestic or resident category. They are the highest taxpayers. Okay. They pay around 30%. Plus, they also have a surcharge if your total income is more than 1 crore, and they also have a cess. Okay. Obviously, cess is common for everyone. Whereas, in terms of a company, the rate was 30. Then it was reduced to 25 in 17-18. Unfortunately, I have not put the remaining amendment here. Now it is reduced to 22. Okay, so technically speaking, that is the revised rate right now. So you have an 8% leverage in terms of a company versus a partnership. Okay, which is huge in terms of tax. That is where the requirement comes in. So now we have Mr. H.S. Butt, who was mentioned, when partners are more in LLP, how profit sharing ratio is stated in the agreement. uh, as of now, you can formulate it based on the activity. Okay, so what we do is, if, and in my experience again, we have one, we call it as a full-fledged hospital. It's a hospital with, that means it has 6 rooms effectively, and there are 12 doctors who operate it. Okay, under different structure. There's a neurologist, there's a gynecologist, there's a pediatrician, there's a dietitian. So all these people come. So they have specified times and they have specified uh, client base. So they take their fees as and when, as per their structures. So they have given a structure, as per the agreement. They've given a structure. So they take the fees. Beyond that, on completion of all the activity and the profits of that hospital is shared based on time spent. Okay, that is how we have formulated the agreement. So we have an time tag. Okay, and that is very easy for them to handle, because they say we logged in for so many hours in a month, and based on that, we split total number of hours allocated, split it for, divided by the total number of hours of all the doctors versus the so many hours spent. So that's how we distribute the profits. In other LLPs, we go simple, like we say equally to all partners. In certain cases, we say these people these rates, these people these rates. So that's how we formulate. Okay, there's another question which says, sir, in LLP and partnerships, we can share profits based on profit sharing ratio. In a company, we can share it based on the share capital. A director is having an idea of business but would not have money to bring in. Is there an agreement, arrangement to share the profits is not based on the capital introduced? Yes, sir, definitely. That is where the commission and other roles and remuneration come. So very clearly we can formulate. It is not a challenge at all. We can say that he is eligible for an additional, based on the performance of the company, he is eligible for a commission. Okay, that is definitely allowed. There is no restriction on that at all. So we can share the profit, or we can say the profit is first given for his contribution. After that, post that, we will distribute the profits to the shareholders. So that is definitely possible. That's not a challenge. Yeah, thanks for keeping this session very lively. All of you are putting all your thoughts across. So thank you so much. Yeah, so coming back to the income tax rates, at present, it looks forming a company is more viable. In fact, if you are starting manufacturing entity, your rate of tax is only 15%. Okay, a newly incorporated company with the manufacturing background is only 15%, compared to an LLP or a firm where you are paying 30%. There's a 15% gap, and that is the key, or that is the highlight of majority of these activities. Okay, so that's how we are looking at structures. So when we are planning the structures, when we say earlier, at least 2 years before and all, when we are planning, saying that everything is anyway under 30% only, then slowly the rate started dropping. Okay, then the 5% margin came in. Okay, saying that company versus and partnerships, you get 5% margin. Then going forward, we say that no, under companies now we get a shelter of 22. You're newly starting a company which is in manufacturing sector, you get 15% alone as tax shield. Then to that extent it becomes much more mind. It just turns around the whole picture, which is more viable, which is more profitable. So that's how it is being looked into. Then again, Butcher has come up. He's saying, sir, can LLP share profits in proportion of capital of partners? Yes, yes, that is also possible. No issues. We can definitely contribute that way also. It's just a structure, and we have to mention that specifically in the agreement. That's all. So you can formulate in any way. Unlike in a partnership firm where we specifically say the ratios, in an LLP we leave it a bit open. We don't say the ratio as such. We say it's on this proportion, that proportion also is possible. So that becomes a bit more easier to operate an LLP than an partnership. So this is one of the change, one of the key differences. Yeah, okay. I put the next slide here. Okay, this is the game changer. These sections are the game changers. We have companies which can go under 25% slabs. We have companies which are we can go under 15% slabs, and most of the companies go under the 22% slab. So even if you start a company and it goes under 22% slab, there's an 8% of income tax savings which can be transferred into the hands of the shareholders, which is not possible in terms of a partnership. Okay, so that is the difference between the company versus LLP. Obviously, there is a flip side to it. Okay. The flip side is in a partnership, post-tax profit, whatever is distributed, is exempt in the hands of the shareholders. Okay. Section 10(2)(a) very clearly says it is exempt in the hands of the shareholders. Coming to Companies Act, obviously LLP also post-tax profits are exempt. But coming to Companies Act, what happens is we have the only route is to give it out as dividend. Then when you're planning to give out the dividend, obviously there is a hitch called as dividend distribution tax, which was there till 31st of March 2020. From 1st of April 2020, that also is gone. So for a new company, for a company which is presently available, there is the tax saving is obviously there in terms of this. But again, there is a small hitch. The post-tax the share of the profit which is distributed as dividend, unfortunately, will become taxable in the hands of the shareholders. So that's again based on the slab rates and other things, you still get that benefit. There's still cap fixed. But other than that, if you are not planning to distribute the money to the shareholders, you're looking for a reinvestment, growth, and other things, the most ideal option would be a company. That's how it is looking at the present, looking at the income tax structures. So there, it looks more and more that the government wants more responsible companies coming up, and that's why a lot of benefits have been given. The other deductions which the company directly gets and which is not possible for an LLP or an partnership is section 32 AC and 35 CCT and all those structures, wherein you get additional benefits if you are investing more onto the plant and machinery, or if you are managing into an engaging yourself into a manufacturing sector of specified articles, you get obviously the enhanced deductions, which is not possible under an LLP or an partnership. Obviously, if you are having a higher capital, higher contribution of money, then obviously partnership is not the way out. You obviously look at the companies as the way out. One second, excuse me. Sorry, I had to come out of the slide for some reason. Okay, so going forward, other benefits which are still there, section 35D, preliminary expenses, how the benefit we give, and deduction of the 36(1), 36(1)(9), and all those structures when it comes to family pension and family planning and all those kind of structures. Obviously, companies get the higher deduction than the other entities. So that is the higher advantages that you get. So this is the flip side I was talking about. When it comes to a partnership act or an LLP, the post-tax profits, whatever is shared, is taxable. It is tax-free in the hands of the partners. So you pay 30% at the hands of the firm. Remuneration, whatever is paid, is taxed in the hands of the partners. Interest, whatever is paid, is taxed in the hands of the partners, because we get the tax shield in terms of the partnership. It is taxed in the hands of the partners. But once post-tax, whatever is being distributed to the partners is completely tax-free. Earlier under Companies Act also, we were having some similar clause. Whatever is coming into the hands of the shareholders was considered as tax-free. Okay, but unfortunately, in the last budget, they removed off the benefit called as Section 1034. Okay, which was giving the exemption for dividend which is getting distributed. For dividend which has to be paid, it is under Section 115O. Again, it was in Section 115O. You pay something called as a dividend distribution tax. That was again a bit of a costlier affair. It becomes 20% post-tax profits. You have to shed around 20%. Based out and after the 20%, whatever was there only, we could give it as dividend. That's how we always structured. Or overall, we say, including the dividend distribution tax, you can give it to the shareholders. But under Companies Act, after the amendment, this 1034 is not there, so 115O is not there. Okay, so we'll look at that. I think I've got the next slide on that also. But we stopped looking at 115O as a possible way to pull out money. Okay, there is a provisions of section called as 115QA, which talks about buyback tax. Okay, and buyback is a much easier or a much more comfortable position than dividend distribution, according to me. If the company is really doing well and they want to keep monitoring themselves, then buyback is always the most viable option. So what happens in a buyback is, again, you pay 20%, which is equal to a dividend distribution tax. But once it is distributed after 20% of tax liability, there is no tax in the hands of the shareholders. Shareholders, there's a capital gains will come because he is surrendering his shares. He is relinquishing his right over the shares. So once that relinquishment happens, there is a capital gain which has to pay, which he has to pay. But based on this provision related with Section 10 exemption, he is exempt from paying taxes on that capital gains. Okay. So now comparing dividend distribution versus your buyback. Okay, dividend distribution, you have to pay 20% anyway, and post that earlier it was fully exempt. Whatever was in the hands of the shareholders, it was fully exempt. Then slowly they introduced Section 115 BBA, wherein it said more than 10 lakhs as dividend, you have to pay 10% tax. Okay, that is not there when you pay tax under 115 QA. Sorry, in both terms, more than 10%, both of them are suffering. That is dividend distribution as well as 115 QA suffers 20% tax. But in a dividend distribution more than 10 lakhs, the shareholders still have to pay a tax of 10%. Whereas in 115 QA, that is not there. So the 10% extra tax liability in the hands of the shareholders will not be there if you are going under 115 QA. Again, there's a small hitch to this. Once you go under 115 QA, there is a dilution in terms of your shareholding. Okay, you leave the option open. People who want to take it can take it. They take the money, they go out. So the person, say for example, I already hold 50% of a company, and there's a buyback which is coming in. I surrender the shares. My partner or the other shareholder who's also holding 50%, he is not surrendering the shares, or he does not want to go with the option. Then my holding versus his holding, there will be a difference. We were 50-50 holding before. Now I may become 20% lesser. He may become 50. He may have 70. I may have 30. So that's how the shareholding pattern will change. But again, if both of them are willing to surrender, then very beautifully it can be planned. So, any doubts so far in income tax? So I think I complete the whole activity of Income Tax Act. 115 QA is a beautifully tax planning tool which we have used effectively in the last few years. Okay, going forward, yes, in the hands of the shareholders, the dividend is getting completely taxed, but 115 QA is still there. They have not pulled out this section. So what happens is that you can still pay 20% tax in the hands of the company and still get a tax-free income in the hands of the shareholders. So it's still a very, very vital or a tax planning tool which is still available in the hands of the company. So you just need a structure. So again, when we are discussing these kind of structures, the shareholders come up and say, see, I'm the shareholder today. Today my share capital is 100. You are saying you can pull out up to 25 rupees. So I'm pulling out 25 means the share capital is going down to 75. The banks will not allow. So again, if your company is profitable, that's why you are pulling out the money as buyback. So, and there is option of something giving us a bonus. 1 year you can give buyback. 1 year you can give bonus. So you can recoup it back. The next year again you can go back to buyback. It's not a problem. To that extent, you can still do this activity and go on. The bankers will also be happy. So that is still a effective way of tax planning. Just that we need to know what is the limits, how to ensure that the amount can be pulled out. So these are the advantages when it comes to income tax. Now let's look at the other forms requirement. I don't think PF, GST, or Central or ESI and other things, all other statutes, I don't think gives any distinction between an LLP or a firm or a company. All the provisions are the same. All the requirements are the same. There's no special benefit for someone or other things. Even if you're looking at the present scenario, COVID scenario, anyone less than 5 crore turnover, everyone gets the same benefit. Let it be a company, let it be in LLP, let it be in partnership firm. Everyone gets the same treatment. Okay, so other than Income Tax Act, which gives you the distinction between a company versus an LLP by giving certain additional benefits to a company, there is no other statute which actually gives any benefits for others. For them, everyone is in the same portfolio. Okay, so that is how the distinction comes in. So now coming into the last part of my presentations, I have put up some of the forms which are mandatory. Okay, some forms which we are forced to take. Okay, and these are the differences why a person prefers a partnership form to this thing, because every time you file a form, there is a fees attached to it. Obviously, the charges of the chartered accountant or the company secretary who's filing that also get attached to it. So that is the pinch of salt which he has to take. But once if you convince or if you're able to explain the benefits of the company, these are not material costs which will be making to look. Okay, so what are the forms? As I told you, AOC 4, which is an annual return. Okay, if you have consolidation, then you have a consolidation return also. AOC 4 consolidation is also there. There are two forms, XBRL, non-XBRL. Bigger corporates go for the XBRL form because of the requirements as per the XBRL rules. Most of them are all private. Most of the private limited companies and others go under the non-XBRL route. This captures most of the information relating to your balance sheet and P&L. Okay, when this form should be filed, it has to be filed within 30 days from the date of your AGM. Okay, again, one thing which I always caution my fellow members whenever I talk about Companies Act is one common point which all the shareholders for some reason have taken into their mind is 30th September is the last date for AGM. Okay? 6 months from the end of the financial year. So 30th September is the last day for AGM. So for them, n number of private companies they have, all the AGMs is only on 30th September. Okay? No distinction. Okay? And for some reason or the other, okay, all AGMs happen between the time 10 to 11. I don't know why. That is the time. So if you are the shareholder, if you are the auditor for 10 companies, 10 companies will have AGM on 30th of September. 10 companies will also have the AGM between 10 to 11. Okay, that is how it is unfortunately documented by many chartered accountants. But please note that Companies Act, to that extent, twisted one line here and there, okay, and made it compulsory for the auditor to attend any general meeting. Okay, so what is this which is creating a problem? Okay, it says that the auditor, okay, has to be physically present. Physically, I'm using the word again, physically present in the general meeting. Okay, if he is not able to be physically present, he should send a representative who should also be an auditor. That means he should be a chartered accountant and he should be independent and he should be able to do it. So if you have two partners in your firm, one partner can go for one set of AGM, other partner can go for the other set of AGM. That is possible. Okay, or you have a qualified chartered accountant working in your firm. That person can represent you and the firm in an AGM or a general meeting. But you must be physically present. If you are not physically present, we should have a prior consent from the shareholders with a proper reasoning as to why you are not able to be physically present, and that has to be recorded in the general meeting. Okay, 90% of the opinions which come to me, I find that this is not followed. Okay, which is a serious violation under Companies Act. Okay, so please remember, mandatory requirement under Companies Act is you must attend all the general meetings. So that is why my calendar is always shared. My September calendar is always shared with my managers. So they will always go and pin a particular date and block the date. Okay, irrespective of whether I am how I handle myself on that particular day, they'll block the date. So I will know, okay, on this slot I'm supposed to be attending that meeting. So I will know that very clearly. So I will not give that time to anyone else. Okay. In fact, I was reviewing one of the one chartered accountant came to me for his help, and I was just reviewing his documentation to suggest how we can go. He's a very good friend, so we are just sharing some thought process. You won't believe he has attended 15 AGMs on 30th of September across Kerala. Okay, each out of which 6 companies are in his hometown. Okay, remaining companies, 5 of them are in 5 different cities in Kerala, and the remaining 4 entities are in Cochin. Okay, so he has been physically present for all the 15 meetings. That's how it's recorded. Okay, physically present. He is physically present for all the 15 meetings, which happened within. Fortunately, he put everything in different times. From 10 o'clock to evening 5 o'clock, 15 different AGMs is attended in the state of Kerala. Whether it's physically possible, he should have been flying from one place to another. That's the only way he could have done it. Okay, but that is how it's been recorded. Okay, whether it is being looked at it seriously right now by ROC, as of now, no. But if they want to pull you out, these are all the tools they use to pull you out. Okay, so please be careful to that. Again, coming back to AOC4, it is 30 days from the date of which the AGM has been completed. It is not 30 days from 30th of September. Again, people say 30 days 30th of September. No. If you have put your AGM of 25th, is 30 days from 25th of September. Okay, please know that there is a clear distinction which is needed. Then charge form CHG1 is for application for registration, and CHG4 is satisfaction. Both are 30 days from the corresponding date. So that also has to be looked into. The newer forms which has come in is DAR3 KYC norms. These are all the smaller problems which we are facing now, especially when we go to directors and say, sir, we have to do some small verification on your part and we have to file one form and all those things. Then it becomes a bit of a difficulty. But yes, ultimately to identify whether any dummy directors are there, non-compliant directors are there, these are the only ways to pull it out. Okay, so we have a time from 30th of April as the time frame for that. So can we have a virtual AGM? Yes, sir. I'll come to it towards the end of my session. Yes, this year that is going to happen. Prabhu sir, please give me some time. I will just come back to you. I'll come back to that. And as I told you, if your resolutions are those lines which is covered in section 117, then you have to file something called as MGT 14, which is 30 days from the date of making the resolution, but also needed. Then we have something called as a DPT 3. Okay? These are all the newer forms. Okay, DPT 3 is return for deposits. Again, may not be applicable for smaller entities, but many entities, unfortunately, they get caught with DPT 3. Okay, so that is the challenge. What is that which they get caught is the customer advance. Please be very clear. If you have entities, one very common thing they have is customer advance. And if the customer paid advance is more than 365 days, then it is considered as public deposit. Then you start filing DPT form. Okay, so that's how it is being worded. So please, these are all the smaller features. You have to be very what to say. You must have clear ideas. You must be proper in terms of accounting and funding and all. If that is there, then obviously companies will not have an issue. As I told you, MSME form. Okay, Government of India right now very keen on growing MSME and other things. MSME is the only thing, even during COVID season, MSME is the only section which has not been amended. So even under COVID scenario, you're supposed to make payment to MSME party within 45 days. If you don't make payment within 45 days, you have to make the payment with interest. They are due. They can claim the interest from you. So that's the benefit. And we have been seeing how the amendment in MSME came in, how they have changed it. Earlier it was only based on capital, based on plant and machinery investments. Now they have incorporated turnover with capital combination, and they have incorporated and introduced a new thing. And so many people are eligible for going under MSME registration. So once you have registered yourself as an MSME, then to that extent it becomes much more easier to handle the structure. The other form which we may need to look into is ADT1, which is for appointment of auditors. Again, this is filed by the company within 15 days from the date of AG. Okay. Yes. So before going to the last slide, virtual AGM. Yes. So what we have to have is this time because of COVID, there is an option called as virtual AGM which has been introduced. There are virtual board meetings which are already introduced. It was there for last 2-3 years. But virtual board meetings were not kind of detuned, kind of used by smaller corporates so far. But right now, this year, specifically this year, you may have to definitely have virtual board meetings itself. As I told you, because if the directors are sitting in different locations and quorum is a challenge, we may not be able to physically record a board meeting. So for physical recording of a board meeting, we may need to find a virtual tool. Okay, that's what we have been doing so far. In the last 3 or 4 months, the main role of us has been to ensure that these board meetings are done and it's been recorded. Okay, similarly, you can do a virtual AGM. The rules have been framed. It came somewhere. The older rules were there for a listed entity and all. For smaller companies also it has come in. Somewhere around February, if I'm not wrong, the newer rules came in, where it gives an option of leaving virtual AGM. And this year, definitely, unless and otherwise the shareholders are within the same city, again repeating, within the same city, it may not be possible to conduct a physical AGM. It may be only via a virtual meeting. And now the challenge is open. Okay? Once it becomes a virtual meeting, recording is mandatory. Like we record this Zoom meeting, we will be recording that meeting. So you will be forced to go through the agenda, read the notice, ensure everyone acknowledges it, read the shareholders report if needed. If there is any qualifications, it must be read. So all these things will become a mandatory requirement. E-voting can be given as an option. If you are not giving e-voting option, then you have to go for a through poll in the virtual meeting, and that has to be recorded. And recorded in the sense it will be read. It will be said, okay, so and so people have said in favor, or all of them have said in favor against is so and so, so and so. That all will get captured in the virtual meeting. So that will be the challenge. So we have to go through a virtual meeting if and only if the quorum is not there for an AGM in the same city. Otherwise, if it is possible, we can still go to the physical meeting. That's how we pray. Next, Shankar sir has put up another question. He has said whether security deposit collected from customers need to be reported under DPD3. DPD3, it is not considered as a public deposit. Sir. Please understand, security deposit collected will not be considered as an public deposit. Under the deposit rules, there is a specific clause, okay, which says that any security deposit taken for the purpose of a specific purpose, then it will not be considered. The best example I can give you is these showrooms, vehicle showrooms. Okay, they will take something called as a deposit, 10,000 rupees or 15,000 rupees on booking the car. Okay, after you take the 10,000 rupees or 15,000 rupees, once the car is available, they call and say your car is available. By that time, that person is not willing to take the car, then this 10,000 will always remain and it keep piling up. Okay, and that is a recurring problem for them. Then, in those cases, these security deposits are not covered under public deposits. There's a specific exemption available under the deposit rules, and hence we have to show it under DPD3 as not a public deposit. Okay? The DPD3 is an annual form anyway. Okay, you have to show it as not as a public deposit. There are columns available for that. Okay, so coming to my last slide, I think I'm almost time. Yeah. So how do you structure a entity, whether to take a firm or an LLP or a company? First is obviously looking into the primary nature of business. If the business is going to be big, it's going to be reasonably sized, where funding is to be looked into, various funding structures are to be looked into, then obviously companies is the best route out. If it's a small organization, you can go with partnership. Small organization but number of people are more, then you can go as an LLP. Other than that, nature of business will be looked into. Okay. Once you look at the nature of business, then we look at the capital commitment. Once the capital commitment cost again is big, is huge, then obviously companies is the best route out. If the capital commitment cost or the overall investment into the entity is not that very significant, it can be managed otherwise, then obviously you can go with partnerships or LLPs. The third thing that obviously you look into is the number of members. As I told you, anything beyond, I would say 15, anything beyond 15 in a partnership is too difficult to manage. Maximum ideal number would be 20. LLP, even though there's no restriction, we don't recommend anyone to go beyond 25. It's becoming a challenge there also. But yes, LLPs are there with the bigger numbers also. Companies, if you are looking at a bigger role for the shareholders, then public limited company. Smaller role for committed role, then we look at private limited companies. Single person handling everything, then obviously one person company. So again, that would need to be looked into. Size of the operations, how big is it? Whether you're going to look at the manufacturing, various levels of manufacturing. Then obviously banks prefer a company to other organizations. Funding also, if we are looking at a funding from the bank's perspective, yes, they would prefer a company over the others. So all these are something we should look into. Then obviously statutory requirements. The statutory requirements, I mean, is the responsibility and the liability on the members. So obviously when you're looking at those kind of structures, obviously companies take an upper hand over the other two. But smaller businesses, smaller operations, obviously we can still go with LLPs or firms. So that's how we look into it. These are some of the criteria which we always look into before taking up, before suggesting an idea to our clients. So I let the floor open for any further questions, which I think I have had one of the most interactive CPA sessions so far. So if furthermore if any questions are there, I'll be able to, and I'll be able to take it. Thank you.
So thank you very much, sir, for your excellent presentation and enlightening the participants and members of Kannur and various other branches. Absolutely, I feel some yoga touch throughout your presentation, because whatever may be the question in the chat box, you are not confused, you are not excited, calm and quiet, and it was some yoga touch was seen in all your presentation. Absolutely great, sir. Great comparison between firm, LLP, and companies. Now I request the members, those who have anything is to be clarified, please use this opportunity. Any doubt, you please interact by unmuting, and even you switch on your video and please interact. He is a good friend of Kannur branch. Please. I think, sir, you have gone through all the questions in the chat box. Yes, Shagar sir question. But I have got 2-3 questions in my WhatsApp personally.
Okay, sir. Please.
One question is that what are the procedure that is to be followed when a partnership firm is converted into LLP? Normal procedure. Could you please explain?
The procedure is, you see, there are a couple of hitches if you convert it from an partnership firm to an LLP, or a partnership firm to a company. The hitches is the GST and other things change already comes in. So what we as an easier option do is, because the business should not get disturbed. So what we always structure is, we form the company first, and the company absorbs the partnership firm. Okay, once that activity happens, absorption as an activity happens, anyway, income tax does not give you the restriction. Okay, section 47 is still applicable, and it still says that it is completely exempt from capital gains tax. Okay, only requirement under the company income tax act is 50% of the shareholding should remain for a period of at least 3 to 5 years. That's how they keep as a requirement. Other than that, how we generally formulate is, we start a new entity, get the GST and also, then we absorb whatever is there in the partnership into that, and ensure that the partnership ratio, the crux is the ratio in which the partners share the profits and the capital which is there in the partnership firm. Same ratio should be maintained in the company also. That is the only thing which we need to ensure, and that is what is needed for the Income Tax Act purpose also. Other than that, no other thing. We can go under the various routes or various methods which is possible. Generally, we go with an option called as a merger option, where no revaluation, nothing. As is various places we take it. Okay, and that is also giving us an advantage in terms of the WDV which is carried for the purpose of income tax. So that is the only thing. So only thing you have to ensure is the capital ratio is maintained as the shareholding ratio also. That is the only thing which we need to look into. Other than that, no other requirements.
Right, sir. So could you please close your that PPT sharing so that we can have the full screening of all?
Yes, sir. Sure. Yes.
Thank you, sir. Another question, the WhatsApp is whether any person can be a member of a company, whether a partnership firm can be a member of a company, either in the, or any person, any partner of a partnership can be the member in the capacity as a partnership.
It is not, a partnership firm cannot be a member, sir. Only a partner can represent the firm in this thing. He can only be, the firm can only be the beneficiary owner. The actual owner should be the partner only. But the reverse is possible. The company can be a partner in a partnership firm. That is possible, but the other way around is not possible.
But sir, when a person is representing on behalf of the partnership, then it will be only his individual capacity only. Whether
yes. On his individual capacity only.
So no benefit to the partnership.
He can, what he can do is he can take it and then distribute it to the partnership.
Another question. At the time of drafting the deed, if the capital is fixed as say rupees 10 lakh, whether the partner should mandatorily bring that the entire amount on lump sum basis in the case of an LLP. That is, the deed is fixing a capital as 10 lakh.
No need, sir. Not necessarily. We can still have an adjustment between the current and the capital account. So that's not restriction. Again, we don't insist that the money should be pumped in full. It can be pumped in over the time also. Based on the requirement of the LLP, they can start pumping in. There's no difficulty in that.
That means there is no mandatory requirement that even though the deed is specifying some amount, you need.
That is the maximum or the full benefit value, but you can reduce it also based on the requirement of the deed. You can have an attachment deed or say that the capital will be restricted to this at this point of time. That is definitely possible.
One more question is there, whether the promoters can have the share capital in the form of goodwill or non-cash transaction while incorporating the company.
Can you repeat the question again, sir?
The promoter can have the share capital in the form of goodwill or non-cash amount while incorporating the company.
Non-cash is possible. Goodwill, I have not seen. That means to say he can contribute it by land or any other tangible assets, or even as an intangible asset like a trademark or something he can bring in for which he can get his share capital. But goodwill, I don't think upfront is possible. It is not right to say newly incorporated company will not have a goodwill. But as an existing firm or something which has already been established, then to that extent they want to contribute some percentage of the share as the goodwill contribution. That is something that needs to be tested.
Now the question may be on account of the fact that there are certain cases the promoter is doing everything for, and he may have some right or some technological benefit, what I could say, that right may be there. So in that case, if 10 lakh is the capital, he may argue that so for 5 lakh I will take the share capital upon which I will not pay any cash. That is my goodwill. And balance 5 lakh, the other shareholder should have to go. If that is possible.
Majorly, if it's a newly incorporated company, then the concept of goodwill is not there. If it's already an established entity, then you are going for an enhancement of the capital. Then you can start negotiating with the contributory, the person who's coming in as an additional contributory to the company. Then you can start negotiating in terms of the firm value and how the valuation of the firm company has to be looked into and all those structures. Right. So that time we will say that the 10 rupee share is to be valued at 100 rupees, and so his contribution, even though he's bringing in the full value, he'll be given a lesser amount of share. So that is how you will negotiate when it comes for a company. Otherwise, you will not do.
Okay. So one question, final question is in the chat box.
Yes, sir. Yes, sir. Yes, sir. What about cooperative society is becoming member of a company? A registered cooperative society can become, sir. Yes, it is still possible. Registered cooperative society can become a member of a company. There is no restriction. Even a registered trust can become a member. There is no restriction.
Right. So anything is to be clarified, participants, or else we should have to wind up because the time itself is 8:50. And the seamless flow of presentation for the entire 2 hours without wasting any single day, so a single time. Now, anyway, I'm going to conclude. I requesting the Secretary of Kannur branch, Shivaprasad sir, to propose the vote of thanks. Sir.
Chairman of Kannur branch, Chartered Accountant Jayaprakash, very esteemed member and a very renowned and learned speaker, Chartered Accountant Rengarajan, my dear members in the profession. It is quite often that most of us have gone through the situation of advising our clients, which is better, either partnership firm or company or limited liability partnership or even proprietorship. Sometimes it may be confusing to advise our clients. It may be depending on many factors. Today we had an especially useful discussion on this topic. We are fortunate that for leading we are fortunate that for leading the discussion, we had a very renowned chartered accountant, Rengarajan. He presented the paper in a very nice way and beautifully explained the pros and cons of the three constitutions: partnership, LLP, and company. Further, he elaborated the precautions that we have to take in our role as chartered accountants. We are very grateful to him for sharing his valuable time, for being with us, and for the excellent presentation. Thank you very much, sir. And we look ahead to your continued support and association with our Kannur branch. I express our sincere thanks to the chairman, Chartered Accountant Jayaprakash, for presiding over the seminar and for his initiative in organizing the wonderful CP seminar. I am very pleased to express our sincere gratitude to all the members for their gracious presence and for the active participation. It is our prayer that let us overcome this pandemic situation at the earliest. Please take care, my friends. Good night.
Thank you.
Thank you so much, sir. Thank you so much. Stay home, stay safe.